Hi, this is Skyler with Regan. Today we'll break down investing in an index versus investing on the wings of the curve. If we look at today's Treasury curve in green here versus the curve when it basically peaked out, which was last Halloween, almost a year ago, um, you have a much more inverted curve actually today where you're getting in cash versus the belly versus where you did a year ago. A year ago, you could put money to work across the curve at almost 5%, a much better time to invest in the belly versus today. But yet we have talking heads, big firms, big fixed income managers out there telling us to move out the curve. So let's take an examination of that. I call it jumping into the duration pool, where it's the deep end of the pool versus potentially sitting here in cash. And if you need duration, potentially going out and slicing in some longer duration paper where the curve is actually steep. So if we look at the indices out there, let's just focus on the US Treasury Index, currently yielding a little over 4% with a duration of 6, okay, versus that curve where you could be investing in cash at about 480. If we break down that Treasury Index, you have a duration of 6, an average dollar price of 93, a coupon of only 2.9. Look at the coupons and the maturities on the index. So when you invest in an index, whether it's the Treasury index, whether it's the ag, you're investing in a market weighted index. So you're going to be very heavily skewed towards what the government or Ginnie Mae or Fannie Mae, et cetera, have issued. For example, in mortgages, most of the outstanding issuances out there were issued in 2020 and 2021 at very, very low coupons. Okay. So you have an option. You can sit here at the front end of the curve and marry it up with longer duration assets that are higher yielding. Or if you're investing in an index, you're probably focused on this part of the curve. And if I presented this to an investor, let's say it's a retiree, and I said, hey, do you want to go and invest at 3.9% yield, or would you rather invest at 4.8% yield? They're not dumb. They'd say, hey, I want the higher yield. So, but some folks have to invest at a certain duration. They have to marry up an index. So what we did is we looked at the last 5 years and we said, okay, if I put $100 million into the Bloomberg Treasury Index, okay, where would I be today? I would have actually lost roughly $1 million. Okay. Don't believe me? Let's look up total return. Let's look at the last 5 years. Voila. You're down 1.02% for an annualized loss of 20 basis points. That's September of 2019 through September of this year. Okay. So you'd have lost about $1 million. So, well, what if instead of spending $100 million on just the index, you could spend $100 million in a mix of 30-year treasuries and T-bills? So my expenditure in 30-year treasuries would have been roughly $33 million. Now you have $67 million in excess to do what you wish with. We hypothesize that you're going to put all that money in bills. Okay. Put it in a very, very safe investment. Okay. But long story short, you have $67 million of extra cash. Now, to go out a little bit, let's say you put that money in strips. So you would have only invested $25 million and you would have an excess of $75 million, obviously, to do with what you wish. Okay. But long story short, what we do is we um, rejigger this on a monthly basis so that we're matching up the duration of the index. What does that result in? It results in if you did 30-year end bills, you would have basically broke even. You would have only lost $87,000. But if you would have done strips, which are a lower cost instrument, and I tell folks, if you want duration, go buy duration. Okay. So there is a huge market out there in called treasury strips. And I'm going to look at the strip that we used, this November 44 strip, which is currently yielding 4.71. And if you go out and you buy that bond, you're only spending $39 on that bond. Okay. So you get to buy this 30-year strip, or it's about a 20-year strip. 2044 is when it matures. So you get a 20-year duration. And that's the beautiful thing of these strips is that if you buy a 20-year strip, you're getting roughly a 20-year duration. Okay. So if you pair that up, you would have made an extra 1.78%, $1.78 million on $100 million over the last 5 years. The delta there is about 35 basis points a year. And why does this exist? Why does this exist over the last 5 years and especially today? Well, when you look at the curve, this is actually the worst part of the curve to invest in right now. You would much rather accomplish that task of getting that duration by partnering up this node with this node. So you can do this in corporates, in munis, in treasuries, in a total return portfolio, etc. You can buy much higher yielding securities to accomplish the income portion of your investment. And if you need duration, you can buy duration. And buying strips out there is the cheapest way to do it. We've shown you over the last 5 years how you can make an extra 35 basis points a year, an extra $1.75 million on $100 million invested. This isn't rocket science, but it takes regular rebalancing and paying attention to the curve in the market. Thanks.